Hi guys, welcome to the next lesson. Today we will be quickly going over how to find premium and discount prices within your trading range. Now, premium and discount prices are very important to understand because it gives us an idea of retracement within a trading range as well as where there may be draws on liquidity depending on premium and discount prices, and those are really just prices that bigger institutions will look at to have their draws on liquidity within a trading range. So if a price is cheaper to buy, cheaper to buy out, to buy at, normally the bigger institutions would want a better price within that trading range. Vice versa, they would want to sell at a premium price for a bearish market. So we have a simple trading range here, right? So we have a strong low here, which created our low within the trading range because we took liquidity and we also broke structure, meaning that this low is strong in a bullish market, and this would be considered our low of our trading range. And this would be considered our high because price had broken structure in the opposite direction. So this would be considered our high. Okay. So when you're looking for premium and discount prices, you are only able to find them once you have identified a trading range. Okay. You shouldn't be marking it up with any other structure aside from a trading range. Like I said, if you do trade Fibonacci's, then you would understand that we're always going to measure from the low to the high or the high to the low, and it would be the same thing when it comes to premium discount prices. We always want to measure from the low to the high or the high to the low. Okay, so we have our trading range here, and we're going to measure that with our gone box tool here. So we're going to measure from the low to the high. And what this tells us is we want to buy anything below the equilibrium. Okay, so the equilibrium is going to be essentially like the middle area of the entire trading range. So we'll call it the equilibrium. That is going to be the middle point. Anything that when price passes the equilibrium, anything below that would be a good price to buy at to continue bullish. So anything beneath that, institutions will look at to continue bullish or have their draws on liquidity in that area. So if price is hanging out and kind of playing around in this area up here, and we have multiple breaks of structure, fake outs, automatically, if we're still in a premium price, it's not a good idea to buy here at all. Okay. It would not be a good idea to buy in this area, no matter how good structure may look, even on the lower time frame. You don't want to be buying in this area. Okay. It would be okay to start buying if price comes down to at least the equilibrium. Okay. So if something happens here where price would, takes that liquidity and we break structure in the opposite direction, we have this liquidity being taken out and we also broke structure. And say like we had swing lows here and then we had the drawn liquidity somewhere here. Say like a POY was around here and we are on a higher time frame. If this was a higher time frame POY, another thing I will say, POYs on a higher time frame are a lot more stronger and valid than POYs on a lower time frame. That's how it, obviously that's how it's going to be. The higher time frames are key and stronger when they're on a higher time frame. Like trends are a lot stronger at a higher time frame. So if we're seeing like a bullish trend on the 4 hour, but we're seeing a bearish trend on the 15-minute, you're going to trust the 4 hour trend instead of the 15-minute trend. So same with this, right? If price comes into the equilibrium and it does have some sort of reaction like this, it's probably because there was a higher time frame POY within this area And this is all we need. Okay. If price decides to come to the equilibrium area, that's enough. That will be enough for a draw on liquidity. It just has to touch the equilibrium. And sometimes that happens. Sometimes it will come into the equilibrium and it will continue bullish. And sometimes it will definitely go lower. So this is, like I said, where you would need to pay more attention to price action and understanding liquidity. And if you see a POI somewhere around here, or like I said, this could be one of the liquidity models where we're building up liquidity somewhere in this area, and we see that it's feeding into a POI that's somewhere down here. It could definitely do that, right? We can have a fake break and then price to come back down, tap this, and then continue high. But in terms of premium and discount prices, this would still be a good price to buy at as far as a discount. It meeting price coming halfway there is always just enough, okay? And it will be vice versa for bearish as well. Okay, so if we have a bearish trend, price broke structure, we're coming up. There was like a higher time frame POI here. This is just enough for price to go ahead and sell off. The institutions are okay with that. So just keep that in mind. But this is super simple. You always want to do this whenever you have a new trading range, though, just because it gives you a good idea. You don't have to do it. Honestly, it's really easy to just identify the middle of a trading range. So you technically don't need to mark it up, but you can if it's something that you may forget. To be honest, I don't really use this as much because I'm so used to understanding and seeing liquidity already. And I've seen it multiple times that I don't really need this as a guide. But if you feel like this will help you with identifying liquidity, as long as you know that you're going to be looking for an area of interest from the equilibrium and higher, or the equilibrium and lower for bullish, then you can use this as a guide to help you maybe stay patient until price gets to that halfway point or anything below that. And then you can start looking for POIs and look for draws on liquidity in that sense. So this is a really good guide for you if you're not so familiar with premium and discount prices, but this is really all this is, and that's just the importance of it, just understanding it from a psychological level, that obviously bigger institutions are going to want to buy or sell price at a better price, right? They're always going to want to sell from premium, and they're always going to buy it from at a discount. So keep those in mind when you do have your trading ranges.